Well, thank you for checking out Film and Roll Up and Associates Municipal Market Update for the week of December 21st, 2020. We're actually recording this a little bit later in the week than we typically would. It is Wednesday, December 23rd. My name is Adam Bauer, and I serve as CEO and President of Film and Roll Up and Associates. Film and Roll Up and Associates is a municipal advisor to government. While we do the MMU almost every first and third Monday of the month and try to give really current data, kind of what's taken place over the last 2 weeks since the last one was recorded, what we focused on this week was how did things go in 2020 and how did things change in 2020? And that's really where the emphasis is. In January, we'll pick back up where we left off and start doing the bi-weekly updates. But we just thought it was appropriate to take a moment, pause, and share with all of you how things have gone. And there's very little issuances this week in public finance. So really, we're not missing much by taking a moment to reflect. Talk to you a lot about the 30-year MMD and how important the MMD is as a tool a tool or a gauge on how interest rates are changing over time. And what we looked at here is a 30-year AAA MMD. So AAA is the highest rating MMD, municipal market data yield, and a 30 years, a term of 30 years. And this red line shows how things have changed. So as we roll into 2020, everything is looking good, rates are trending lower, and then you can see how the pandemic started to impact things. And really with the government mandates to shut businesses, shut schools, shut governments down, that was that sell everything rally that I've probably mentioned to you a dozen times. And then you can see rates generally trended lower as investors looked up and said, well, maybe selling everything wasn't the best idea. Keeping money in cash or treasuries, which just saw a substantial decrease in their yield, maybe is not the best thing for the long term. And so you saw rates tend to trend down. And at first, I think we all thought that things might open up a little quicker than they did. And so, investors got confident again, but then when the realization set in that this is going to take some time, you saw rates go back up. But then through the course of the year, you generally saw rates trend lower. There's blips here and there. Generally when some bad news happens, you can see some points on the curve there that are of note, but generally rates trended lower, and that really has been what we've seen at the end of the year here, is rates are on that lower trajectory. So you're going to see this box in different colors, but we start off with the MMD yields. So these are the typically double tax exempt, both state and federal, if you live within the state that you're buying the municipal bonds in. And what we've tried to show here is just how much things have changed over the course of the year. The 5-year maturity was as low as 0.16, as high as 2.56, and currently stands at 0.22. That's a pretty dramatic yield change during the year. And you're going to see this over and over. The 10-year, 0.58 to 2.79, currently rests at 0.71. The 20-year, 1.08 to 3.18, currently at 1.17. Finally, the 30-year, minimum of 1.27, maximum 3.37, with a current yield of 1.39. Just want to pause a moment when we think about interest rates and how low or how high they might be. For this 30-year maturity, now an investor can always sell a bond along the way, assuming there's a secondary market to do so. But when an investor buys a 30-year bond, they're potentially at risk of owning that investment for 30 years. So you can see there, they are willing, with the AAA, the perfect credit, willing to lend at 1.39 for 3 years. That is just extremely low. You do get, if you're within the state of California or you're within a state that you're buying the municipal bonds in, you do get that double state and federal tax exemption, but still, that's a very low rate to have your money tied up for such a long period of time. So how does that compare to U.S. Treasuries? And as I mentioned previously, the federal government took actions to lower the Treasury yields as the pandemic was unfolding. Pretty quick to do so. And so here you can see the Treasury range from the 5-year from 0.19 to 1.67, currently at 0.39. The 10-year is one I talked to you a lot about, and that one is lowest 0.52 and as high as 1.88, and now is about 0.95. So generally that, so you've certainly seen these tick up, but still at very low levels for historical standards. And then finally, you see the 20-year currently at 1.49 and the 30-year at 1.7. So the next graph is something, or next table, I should say, is something I want you to focus on because this compares these last two tables. And this says the MMD is what percentage of the US Treasury. So at the beginning of the year, the 5-year yield was 65% of that of the US Treasury. And now it's as low as 0.56. Where you don't see much of a change is the 10-year. Look at that, 76% compared to 75%. Then finally, you go down to the 30-year and you have 89% compared to 82%. So generally, the tax exempt have trended lower and to a greater degree than the taxable maturities have. And you've created a bit more of a widening between the two. Now, of late, we've seen the taxable yields start to drift lower as well. But I should pause for a moment there. When I say taxable yields, I'm still talking about municipal bonds. When we're looking at this chart, we're focused on the treasuries. So when I say the taxables have trended lower for municipals, what's happening is even though the treasury yields haven't necessarily drifted in line with the tax exempt, we have seen the spread. So investors require a spread off of the US Treasury when we're pricing municipal bonds. That spread has narrowed to some degree, but not enough to keep pace with the pretty rapid decline or continued decline that we've seen in tax exempts. So this chart, there's a few things going on here, but one of the things I've talked to you a bit about is the taxable versus tax exempt. And so why do I spend so much time talking with the two? Well, in 2020, about 70% of the bonds that were sold were tax exempt, about 30% were taxable. That's a lot of taxable bonds. And 2019, you saw not quite to that same degree. But let's talk about what's going on there. Well, first of all, rates are low. And so you're able to refinance on a taxable basis, even if some of the previous bonds were issued on a tax-exempt basis. Now, why might you need to do that? Well, let's go back to 2017. In 2017, there was a tax bill passed. And with that tax bill, limited was the ability to do advanced refundings on a tax-exempt basis. Advanced refunding is a refunding that takes place 90 days before the call date or the prepayment date. So it used to be for every new issuance, or in most cases, every new issuance, you'd be able to get one advanced refunding done per original issue. And so you had this 30-year period, and you picked your point in time, and then you could do an advanced refunding on a tax-exempt basis. Well, that tax bill took away that ability. And so in 2017, you saw a tremendous amount of bonds being issued in December so that you could refinance on a tax-exempt basis before the deadline in 2018 came. And so we saw, I'm going to show you in a chart in a moment, you saw an increase in issuances in the end of 2017 as the tax bill was going through. And in 2018, actually saw a bit of a dip. But then finally around 2019-20, now it's time to start looking at some of these refundings that otherwise would have been tax-exempt advanced refundings and now are possible to do on a taxable basis. One, because interest rates are low, and two, because we've had a long enough gap with the call features that we can actually come back and refinance that. And what I mean by those call features is typically when municipal bonds are sold, there's a period of about 10 years where we can't refinance the bonds. Or investors say you can refinance, but you have to put money in escrow until that 10-year mark. And so now that we've had some years pass, we already cleared the deck in 2017. We're now seeing some of those taxable deals get done. So what does volume look like? And I think this is one I started to address with you on the last slide. So 2017 doesn't look like a big uptick, but 2016 was a pretty busy year. And so that fall off in 2018 is not necessarily were not things to do in 2018. What's taken place there is issuance got pulled into 2017, create a bit of a lull in 2018, things picked up in 2019, and then further picked up just a little bit in 2020. And those bar charts represent the par amount sold in each of those years. That key is to the far left. And then the green line represents the number of issues that took place. And so you can see we've generally trended back more in line with that 16, 17 timeframe. That 18, I do believe, was really an anomaly that some of the issuances got pulled forward into 2017. But municipal issuers were pretty busy in 2020. So as I wrap up here, we have the Philman Rollap and Associates Registered Municipal Advisors. I want to say thank you to this team. Many of these individuals have worked with you on your transactions, and they were all very well prepared, and just want to say thank you to our team for a very successful 2020. I also want to take a moment to say we're going to have two more folks added to this soon. We've just had two individuals pass the Series 50 exam. So very excited that we'll be able to have them on here and have additional contacts for our clients. And as folks review this and have thoughts or ways that we can improve this, I encourage you to reach out to us. One of the things that we've heard is the acronyms get hard to follow. So about 2 or 3 times a year, we go back and do a kind of a long MMU that really focuses us on what the acronyms mean and kind of why I'm showing some of those. The other thing we did in 2020 was we had the public finance conversations, the PFCs. We're going to change that format in 2021. We did about 20 to 30-minute interviews last time, really focused on individuals and their careers and generally how that fit into public finance. But for 2021, what we're going to do there is we're going to do 3 5-minute questions. And so one will release on Monday, then Wednesday, then Friday. And it really is not necessarily focusing much on the individual, but 3 questions that individual is an expert in. And I think those will be little bite-sized pieces instead of a 20 or 30-minute sit down that you would undertake. Then finally, you get to meet a lot of the folks on this page when we do what we're calling the Fieldman Fundamentals. So the double F. And what that's going to be is the team members on this side are going to select topics and do a 3 to 7-minute introductory conversation about those issues. And we'll post those on our website and on YouTube so that 1, you get to meet some of the other team members, and 2, for topics that you're interested in, you can get a real short, kind of easy to understand summary of it. So I thank you for your time. We certainly have grown this year. I never thought that I would be doing regular video updates to people, but these have been well received. Thank you for your feedback, and we encourage additional feedback, but Happy New Year.